as promised, did I tell you there's not much about the automotive industry that Andy and his team don't know about. Once you start unpacking what's really happening, looking at statistics, looking at studies, like I said before, the future is not as grim as people on Wall Street would lead you to believe. So thank you, Andy, and we appreciate Andy's work on all these issues in Washington, D.C. with NADA. He's a good friend, like I mentioned. So next up in our Marketplace Keynote Series, I want to bring to the stage our dear friend, Ken Shilson. Ken is the founder of NABD, in his own right known as the great oracle of all things accounting. He's a CPA. He's a member of the NIADA Ring of Honor. He's a dear friend and now a part of the NIADA family. So let me bring up to the stage Ken Shilson as we talk about subprime auto finance and all the profit opportunities that go along with that. Ken?
Thanks, Steve.
The great oracle.
Well, thank you very much, Steve, and I want to welcome all of you to the NIADA, NABD Convention and Expo and to Las Vegas. It's great to have you all here. And it's my pleasure this morning to report that the profit opportunities in subprime auto finance today are exceptional. And I'm going to tell you that the time is now. The time is now to capitalize on those. In my presentation, I'm going to show you where those opportunities are. Whether you're in retail, whether you're a buy here, pay here dealer, whether you're a wholesaler, there's profit opportunities for everyone. But I want to say that there are some challenges ahead, and those challenges have to be solved to get to those profits. And I'm pleased to report that in working with the NIADA team, we've designed an educational sessions here at this show that will provide solutions to the challenges that lie ahead. So I encourage all of you to attend the educational sessions. If you came with more than one person from your operation, split up and participate in the 5-track program because the answers are there. All you have to do is go find them while you're here at the show. And speaking of resources, when you checked in and got that registration bag, I hope you got a copy of the BHPH Dealer Magazine, which for the 20th consecutive year, I've done all the subprime benchmarks and working with SGC CPAs, the NIADA 20 groups, and my own company, Subprime Analytics. We've put together a comprehensive report on what happened in 2018. And at the end of my presentation today, or near the end, I'm going to be going over some of the takeaways that I hope you'll learn from as you progress in the months ahead. And finally, I'll conclude with the challenges and give you some ideas on where to find the answers. So let's go ahead and get started by talking about the market changes and trends. Where are these profit opportunities that I'm talking about? Where are they? And that's what I hope to show you here in just a few minutes. And in doing that, I'm going to use some data from Experian to start off with, and I've got quite a collection of data from everybody. But Experian has a quarterly automotive report, and I compliment them. They do a great job in assembling information, particularly in the subprime area. And for purposes of definition, we'll be talking about subprime being from credit scores 501 to 600, and then deep subprime, or buy here, pay here, being scores under 500. So that's the reference points as I talk about that today. Well, how big is the auto receivable market? At the end of 2018, it was $1,178 billion. That makes it the second largest consumer credit market, only behind student loans, because you can't loan money as fast as we can give it away. So the reality is that there's plenty of customers out there and the market is huge, so there's opportunity for everyone. Well, who's financing all that growth? Where's the money coming from? Well, First of all, banks have about a third of it. I'm sure that's no surprise. But it's credit unions that have become a major financing force in the auto receivable space. And I'm going to show you where some of that growth is coming from. First of all, if we look at the different sectors of the auto receivables market, buy here, pay here, or deep subprime continues to be one of the smaller, and it's currently somewhere between $70 and $80 billion of outstanding receivables, so still significant. But remember, a few years ago, about 5 years ago, it was over $100 billion. So we've seen some contraction in the deep subprime space, particularly with the independents, as Wall Street has done a lot of auto bond securitizations, including those in the deep subprime area, push that money out to finance companies, to the captives, and they've been very aggressive in going after the market. So it's been extremely competitive, but that's changing as I'll get into it. But if we look at the lower side, on my right, lower right-hand side of this slide, where it says used financing, you can see that the banks have been fairly flat in terms of the amount of financing that they're providing, still very significant, but it's credit unions that have shown, significant growth over the last couple of years, and they're certainly doing a great deal of financing, particularly in the used area. So you may, in your area, be seeing some competition from some of the credit unions if you're doing some of the deep subprime stuff, because they've been very, very aggressive. Well, what enabled Wall Street to securitize so much of this paper? And if you're not familiar with the auto bond securitization market, it's a very important source of a large amount of capital to our industry. So I'm not certainly criticizing the concept of auto bonds, but as the money started to roll out, everybody jumped in, including those people who didn't really have the experience or the knowledge of how to underwrite or collect it. And that was particularly true in the deep subprime stuff, and a lot of that paper is not working out very well. And Wall Street was able to sell this to investors and lay off the risk by explaining that the borrowers, our consumers, would prioritize their car payments ahead of any other expenses. And so they felt by giving them a great vehicle that they would treasure it and use it as their primary source of transportation, and they'd pay for it above all other expenses. Well, as we all know, it hasn't quite worked out that way. And so what we saw starting in 2016 is some of the credit standards starting to tighten and the market starting to tighten. And that's been good news for us, because Wall Street has now shifted more to a prime or near prime model away from the subprime and deep subprime. So you're going to see less competition from the auto bond securitization market as an independent going forward, and that spells opportunity. Subprime losses started increasing in 16 and progressed through 17 and into 18, and that's particularly true in the deep subprime. Many of these tranches of auto bond securitizations included consumers that had no credit score at all. And some of those were, of course, our customers in the buy here, pay here market. And as David Goff at Westlake said, that has forced us to tighten up our underwriting and tighten our credit standards, and created some of that shift that I talked about just a few minutes ago to a higher quality credit customer. And as a result of that shift, the subprime market at the end of the fourth quarter of 2018 had fallen below 20% of the outstanding receivables. Now you'd say, boy, that sounds kind of negative. That spells opportunity, and I'll show you why. And again, I think that we have to be conscious of the fact that Wall Street drove a lot of the growth with the auto bond securitization money, and as a result of that, as they've started to shift, we're going to see new competition coming into the market. It's still going to be out there, but not in the volumes that we've seen in the past. So subprime hit a low in terms of total used loans at the end of the fourth quarter. And what we've seen is a continuing shift to super prime and prime consumers in both new and used lending. But at the end of the fourth quarter of last year, subprime was still almost 30% of all used financing. So it's very significant. But more relevant to all of you is how significant it is to the independent used car business. It still comprises almost 50% of all the used vehicle sales. And as you can see, if you look over at this slide, in the deep subprime and the subprime area, virtually it predominates the marketplace for independent used car dealers. So obviously subprime continues to be our sweet spot in our market, and hopefully less competition will mean more profits for you. While the market has shrunk, according to experience data, the amount financed has not. The used balances have continued to increase as dealers have tried to increase prices and increase the amounts financed. And as we see in this slide, if you look over at the deep subprime, the weakest credit quality customer, the average balance for all used, that would include franchise used, and that would include independent used, and including used that was financed through auto bond securitizations, the average amount financed has reached almost $15,000. That's a new record high, almost $15,000. And the average used loan in total, all retail and subprime, has now surpassed $20,000. So the amounts financed have continued to grow even though the market has been very competitive. And as the amount financed has increased, so too have loan terms. And I think this is an area that hopefully we'll all learn from. In the deep subprime, the average term of all used is almost 57 months. 57 months. And I think when you're starting with a vehicle that may have 90 or 100,000 miles on it, 57 months is an awful long time out there, and it's even longer in the subprime area. So stretching out the term, I'm afraid, is not going to be the right answer for the used car industry, just as it has not been the right answer for the franchise business. But let's learn from these things. Let's take a look at how the independence business model differs from what we've seen in some of the other used underwriting that's been done, particularly in the auto bond securitization area. So I put this chart together, and I'll take just a minute to explain. In assembling the benchmarks every year, I've looked at I've analyzed over $24 billion of subprime auto receivables, and the operators that we surveyed are nationwide. So we've gotten a good cross section, and I represent to you that in 2018, and this is in the benchmarks report, that the average amount financed by independents that surveyed was $11,768, not the $14,623 that I showed you just earlier with franchise used in the securitization financing in there. That's almost $3,000 less in terms of amount financed by the independents. Term-wise, no, they weren't going 56 months or 57 months. Instead, they were doing 43-month terms. That's still a long time, and still difficult to keep that customer paying that whole time, particularly in the deep subprime, but that's over a year less than what the other used financing was doing. Monthly payments, not $408 average, but rather a $390 average, or a difference of about $18 a month. And the average financing rate was pretty comparable, 20.56% overall versus 20.3%. We've seen in states where the rates are not subject to usury limits or are not regulated, that 20 to 21% seems to be about the average that operators are using today in the independent space. So quite a difference between the independence model and the used car model that others are using. And that's a good thing, because the smart independents decided not to match the underwriting risk that was created by some of this other used financing. And that's the smart thing to do, is they laid off the risk to an investor who in many cases didn't know what they were really going to get. And I think when you're spending your own money, you look at it a little bit differently. So where are these profit opportunities then? You know, how can you capitalize on the market? Well, first of all, new car sales are slowing as national prices have skyrocketed in recent years. And it's generally caused by the fact that the consumers have kind of gravitated, as we know, to SUVs and trucks. And because of the federal fuel economy goals, the infotainment equipment, the safety technology, many of the things that Andy just talked about, that has driven the cost of the new vehicle up to the highest point in history. And Earl Hesterberg, Group 1 CEO, said it best, that he says there's going to be a shift towards the used vehicle marketplace for the industry in general. And we're starting to see that as we start off 2019 and start to get some of the first quarter results in. And the gap between new and used franchise payments continues to widen. It's not getting cheaper, it continues to be more expensive as they've stretched the term out about as far as they possibly can. So the payments have hit new highs, and we've seen that the average used finance payment has exceeded $400, as I said earlier, which seems like a big number, and particularly in some of the markets that you may be in, you may say, that's just impossible. My consumers can't afford $400 a month. But they need to. They need to, because your costs are increasing, so it's important that you get a fair payment, fair repayment to keep your returns and to manage your risk. So with new vehicle prices, this is according to the Houston Chronicle in March, averaging nearly $37,000 according to Kelley Blue Book. Monthly payments are getting out of reach for many buyers, and this creates a great opportunity for you as an independent, because the pool of people who can afford to buy a new vehicle is being reduced by these higher prices and affordability concerns. So far this year, new vehicle loan payments are up 3.5%, and as a result of multiple years of rate and price inflation, new payments have become a big hurdle, which drive people more into the used car space. And while we've seen the average payments being more than $400, that's less than a 1% increase from a year ago. And when we compare that against new car payments, new car buyers agreed to pay an average of $551 a month for 69 months in January of 2019. That's according to Edmunds. That's nearly 10% more per month than years earlier. And the average new car buyer borrowed almost $32,000 in January, making it an all-time high for that month. So it's not only the increase in the amount financed and the repayment amounts, but what's happened to interest rates? While they've kind of stabilized here recently, we've seen a big increase in the financing rate as we started off 2019, as new vehicle finance rates have now surpassed 6% for the first time in 10 years. Interest rates on new vehicles averaged 6.4% in March of 2019, and that's the highest in a decade. And that's also according to Edmunds, as quoted in the Houston Chronicle. So what does this mean as far as the new car business? Well, the total of 4 million new vehicles in U.S. stock in February of 2019 is a 21-month high. And in terms of dollars, in dollar terms, that's $140 billion in new car inventory. So here's our opportunity for the independents to come in and pick up a lot of good used car business with some great customers. Retail, buy here, pay here, and of course we always need the vehicles, so wholesalers continue to play an important part. There's an excellent profit opportunity there for the independents. So earlier I talked about getting a copy of the benchmarks, and I'm not going to go through all of those, but I am going to hit some of the highlights because I think it's important for you to take away some of the things we've learned in the last few years, and particularly in 2018. First of all, shorter contract terms perform better than longer ones. And I'm pleased to say that for the first time in the last 5 years, as you can see by this graph, the independents we surveyed had actually been able to shorten the average term, albeit by only a month, but that's still significant. And I represent to you that these consumers, the time is your greatest enemy with the subprime consumer. And as a result, keeping those terms shorter is so important. That's why you have to get a strong down payment and a strong repayment. And that's what we saw in 2018. One of the things I've been preaching is that continuing to drop your down payment and to lower your repayment is an economically unsustainable business model. And so we have to ask for more. I haven't seen the consumer, the subprime consumer, put his beer back or buy less lottery tickets. So you've got to ask for that money at the point of origination, and you've got to get it. Because here's the sad news. In 5 years, we've only seen a 1% increase in repayments. That isn't even keeping pace with the modest inflation that we've had. You cannot continue to drop your repayments and drop your down payments. It is not economically sustainable. And that's one of the ways that we can continue to shorten the term and reduce the amount financed more quickly. And as I said, we have to continue to keep pace with spiraling cost and inflation. The amounts financed can be reduced, as I said, by down payments and repayments. And what that meant in 2018 is that we actually saw a slight decrease in the average amount financed. In the independents we surveyed, $11,768 was the average amount financed. But more significantly, that's the first time in the last 5 years that we've seen a decrease. So I encourage you to go back and revisit your business model and see how it compares with some of these things. Implementing technology. I can't emphasize how important it is to build technology into your operation. We're in a period of margin compression. You know, the consumer is not absorbing all the cost increases that you have, and so you have to become more efficient, and you have to implement technology. At this show, we have one of the largest exhibit halls in the history of the used car industry. All the technology is there, the capital is there, all the products and services are there to help you become more efficient and more profitable. And I encourage every one of you to spend some time in the exhibit hall, visit with the exhibitors, and learn how their products and services can help you become more efficient. Yes, I know it's challenging to think about making an investment today in technology with as challenging as the marketplace has been in the last few years, but you're investing in your future. You're investing in your future, and that's the only way you're going to succeed in the future. So managing your costs and managing your expenses is a key, and technology is the way to do that. Controlling risk and bad debts. Over the last 5 years, we've seen bad debts as charge-offs increase by 12%. That's a lot more than the repayment increases that we've seen. So controlling your risk and controlling the write-offs is going to be critical to future success. And if you're a buy here, pay here dealer, you've got to use metrics. You've got to understand what's working in your portfolio. You've got to monitor it, and you've got to make adjustments as you go along. Your business model. I've said many times before that your business model controls your risk, controls your cash flow, and it's so important that you not only have a profitable business model, but you have a cash-efficient one. And in this chart, I hope you'll take a few moments to see that, increasing the cost of the vehicle that you're putting in your business model and lowering your down payment just increases your risk and increases your cash and deal. So I'm pleased to say in 2018, we saw a little bit of a decrease in the ACV of the vehicles that buy here, pay here dealers were selling, an increase in the amount of down payment that they were getting, and as a result, a decrease in the amount of cash and deal. It's not enough to go back and look and say, well, on paper, my business model is profitable. You got to look under the hood. You got to see, is it cash efficient? What return am I getting on it? If I was asking you to make an investment in anything, the first thing you'd ask me is, what return could I expect? Do you know the return in your own portfolio? You need to. You need to. And in order to do that, you need to have metrics and portfolio information on your performance. What challenges are ahead? What are the challenges that I think you're going to face to access these profit opportunities in the months ahead? I've outlined them here on the slide. Vehicle inventory. It's out there, but you have to find it. It's not necessarily at your local auction, not necessarily in your backyard. You have to use the sourcing tools that are available to you today. Online auctions like TradeRev and others have become a great source to find the vehicles that you need. So let the internet help you find the inventory you need. It's out there, but you have to work at it and you have to be diligent, because it's never been easy to find the right vehicles for your business model, and that's going to continue to be the challenge. But you can't sell them if you don't have them. So again, look at the inventory sourcing technology and use it to be more successful. Capital constraints. One of the byproducts of some of the losses that we've seen in the securitization market and the higher charge-offs that we've seen in the last few years has been a tightening in the capital markets. And as a result, it's not as easy to go out there and get the financing for your operation that maybe we've seen years ago. So it has to start at home. And it goes back to what I said earlier about making your own business model cash efficient. You've got to squeeze more out of your operation and be less reliant on borrowing and leveraging your business. Again, the capital is there if you have the right business model, the right people, the right systems, processes, infrastructure. We've got a financing fair here. There's money out there, but you have to prove that you're going to be a good financial partner to get it. So the reality is, go back, look under your own hood first before you decide to go out and leverage up, and then continue implementing the right systems and processes in your business, and you'll find that the capital is there. Compliance. We all know that Donald Trump has made a bunch of changes in the CFPB. And perhaps some of you may think that, well, we don't have to worry about compliance anymore. CFPB is not going to be as aggressive as they have. Well, that's wrong, because we've got a new sheriff in town, and that's the state AG. Because the enforcement and policing activity has been shifted to the state AGs. I'm currently an expert witness in 3 cases involving 3 different state AGs against buy here, pay here operators. And I can't emphasize enough how important it is for you to be on your game compliance-wise. The movement of the policing and enforcement to the state AGs has put you on a smaller radar screen and made you more visible. So when they start receiving complaints, you've got to respond, and you've got to make sure that you try to keep your consumers satisfied that you're dealing with them fairly. And that's not an easy thing. It's easier said than done, but it has to start. You're the key to making sure that compliance doesn't become a bigger problem in this industry than it already is. Technology, I've emphasized before how important it is that you look and understand what technology is out there and implement that into your business to have more efficient systems and processes. And finally, training and education. And certainly over the next few days, here's your opportunity to get it, because we've got 5 tracks covering just about every section that you could possibly imagine, and all you have to do is go there, participate, and learn. And also, I'd like to say, we have some of the best operators in this industry here with us this week at the show. So there's a tremendous amount of expertise out there, and I encourage you to network and learn from others, because that's how you become better. 20 groups are an example of that in the sense that you can learn from your peers and you can help each other become better. And I think that's the key in solving the challenges that we have ahead. We all have to work together, the industry leaders and all of you, to proudly represent the used car industry to make it more successful. Finally, I'm going to be in the dealer's lounge during the whole show. And I encourage you to pick up a copy of the benchmarks, but more importantly, to compare those benchmarks against what you're doing. And if you need some help with that, come by the dealer's lounge. I'll be happy to explain to you how some of those calculations were made. It's important for you to understand how you're doing in relation to your peers. I've got regional benchmarks depending on what part of the country that you're in. It's important to know what your competition is doing. So I encourage you to use this information to help accelerate your success. So thank you all for being here. It's been my pleasure. I look forward to getting to talk with all of you during the course of this show. And thank you very much.